All right, if you pay taxes in India, listen up. The entire system as we know it is about to get a massive reset. We're talking about a fundamental shift in income tax law that's going to affect every single one of us, and it's happening a lot sooner than you might think. So let's dive in and break down exactly what's heading our way.
Yeah, you heard that right. This isn't just about tweaking a few rules or introducing a new tax slab. The entire foundation of India's income tax law, a system that's been around for more than 60 years, is on the verge of being completely torn down and replaced. So, what's really at the heart of this massive change? Well, it's a brand new tax law designed from the ground up to replace the old, and let's be honest, pretty complicated system we have now. Go ahead and circle April 1st, 2026 on your calendar, because that's the day everything changes. Starting with that financial year, every single taxpayer in India, yep, salaried folks, business owners, investors, you name it, will fall under this new act. That old 1961 law, it's about to become a museum piece.
And here is a perfect example of the kind of simplification we're talking about. For decades, we've all had to juggle these two slightly confusing terms: the previous year, which is when you earned the money, and the assessment year, which is when you filed taxes for it. It was always a bit of a headache, right? Well, the new law just scraps all that for one single, intuitive term: tax year. The year you earn is the year you file for. So much easier. And just look at the scale of this decluttering effort. The old act was, let's face it, a maze of over 800 sections, packed with legal jargon. The new act slims that down to a much more manageable 536, and it's written in clearer language to hopefully make the law easier for, a regular person to understand.
Now, I know what you might be thinking. Great. A new law probably means higher taxes. But hold on. The government's been pretty clear that the intention here isn't to take more of your money. The whole point of this exercise is to make the system easier to navigate, cut down on the confusion, and just make being compliant a more straightforward process for all of us.
Okay, so you might be wondering, why go through all this trouble? Why do we even need a new law? Well, to really get it, let's look at a perfect and kind of painful example of how complex things are right now: tax deducted at source, or TDS, when you're making payments to non-residents. First things first, who exactly is a non-resident in the eyes of the taxman? Well, generally speaking, it's anyone who is physically in India for less than 182 days during the tax year. So you can think of like a foreign consultant who's here for a short project, or maybe an artist performing a few shows. Okay, so let's say you're paying someone who fits that description. A really important question pops up. Are you on the hook for deducting tax from that payment before you even hand it over?
And the answer, in short, is pretty much everyone. It doesn't matter if you're an individual paying a consultant, a family business, a big company, or even a government body. If you are making a taxable payment to a non-resident, that responsibility to deduct the tax falls squarely on your shoulders.
And we're not talking about pocket change here either. For the current financial year, payments like interest and dividends get a 20% tax sliced off right at the source. And if someone wins money from a lottery or a game, that's a whopping 30% cut right off the top.
And the process itself? Oh man, it's a whole bureaucratic journey. First, you've got to get this special number, a TAN. Then you have to remember to deduct the tax when you pay. Then you've got to deposit it with the government by a super tight deadline. File a specific, detailed return every quarter. And after all that, you have to issue a certificate to the person you paid. It's a lot. And if you think you can just skip a step, think again. The penalties for getting this wrong are incredibly high. Just forgetting to file the required forms, or maybe filling them out incorrectly, can slap you with a hefty penalty of 1 lakh rupees. It's this exact kind of headache that the new law is trying to get rid of.
Okay, we've seen how complicated things can get, which is a great reason for the new law. But that's in the future. So let's pivot and focus on what you need to be doing right now to stay on the right side of the current system. I mean, just take a look at the deadlines for a single month, February. You've got dates for TDS, GST, Provident Fund. It feels like a constant drumbeat of deadlines. And if you miss any of them, you're looking at interest and penalties. This is why just staying organized is half the battle.
Beyond just hitting your deadlines, probably the biggest choice for most of us salaried taxpayers right now is deciding which tax regime to go with. So let's break that down.
So on the left, you've got the new regime. This is now the default option, and you can see it has more steps, more slabs, but the tax rates are generally a bit lower as you go up. Then on the right, you've got the good old regime, And you have to notice that huge jump in the middle there. It goes straight from 5% to 20%. That's a massive difference and a really key point.
So what's the big selling point for the new regime? Well, it's all about simplicity, but with some really nice built-in perks. You get a standard deduction of 75,000 rupees, which is great, but the real headline grabber is the tax rebate. Basically, it means that if your taxable income is 12 lakhs or less, you end up paying zero, nada, no income tax. You don't have to hunt for any complicated deductions.
So with all that, why on earth would anyone stick with the old regime? Well, it comes down to one powerful word: deductions. If you've got big investments under Section 80C, if you pay for medical insurance, if you're putting money into the National Pension System or NPS, or if you have a home loan with a big interest payment, this is your chance to claim all of that. For some people, these deductions can slash their taxable income so much that it actually ends up being a better deal than the new regime.
All right, that was a lot to take in, I know. We've talked about a brand new, simpler law coming in the future, and we've also dug into the pretty complex choices we all have to make today. So let's try and tie this all together. Here's the bottom line. Big, simplifying change is on the horizon, and that is definitely good news. But until April 1st, 2026 rolls around, we're still playing by the current rules. And that means you've got to master the system we have now, understanding things like TDS, hitting all those deadlines we talked about, and making that smart choice between the old and new tax regimes. Really, getting ready for the future starts with being compliant today. Which kind of leaves us with one final thought to chew on. This new act is absolutely designed for simplicity. Fewer sections, clearer language, all of that. But in an economy that's always changing, always getting more complex, will the act of managing our personal finances and taxes ever be truly simple? That's a question we're thinking about.